Skip the bank because these 4 options are much better. My name is Darius.
And I'm Carmen. Did you know that you had other options in store?
Well,
maybe not. Well, today we're here to give you the tea. Spill the tea.
The thing I want you to understand when it comes to banks is the fact that what do we use banks for? The very first...
Storage and lending money.
Right. Storage and lending money. But when it comes to the fact that they are lending us money, they're lending us money for the reason because we don't have money to do it for ourselves. So when it comes to our cars, our mortgages, we finance these things through the banks. Now, what ends up happening is a lot of times we end up paying the banks more in interest than we actually save for ourselves. So the banks have become the most profitable business in the entire world. Mm-hmm. Now, if the banks are the most profitable business in the entire world, shouldn't we start emulating or mirroring exactly what we see the banks do?
Absolutely. But I don't know if this information is common knowledge to a lot of folks.
No, it's not, unless they're subscribed to this channel.
And the reason why I say that is because going back to like our own journey or just programming, before you and I got married, the only thing that I knew a bank for was for, my parents would go to the bank, deposit their income, take money out, go to the ATM machine, do, whatever it is. I never really understood the mortgages piece of things and lending money because I wasn't previewed to that. But it wasn't until I became an adult where, you get in college and they're like, oh, you need to set up a bank account. And then when you're in college, they tell you should get these credit cards because you need to build your credit.
Because you get a free t-shirt.
Or free whatever, right? The incentives. And of course, as a teenager, you're like, yes, I want a free t-shirt. Absolutely. But it's just the marketing that I would say is so strong with the banks, and I'm not faulting them. We are never faulting the banks because we are taking a page from your books. Thank you. The marketing that's involved to get us to get involved and to get in business with them, because at the end of the day, they are a business. And so I wanted to just take a minute to share that, because a lot of times we just use the bank because we know that we need to put our money there, but then we don't know what's happening with our money once it's there. Or we go to the bank because we know we need a loan for a mortgage or a car, or we need credit cards or personal lines of credit. And we don't necessarily stop to think about what's in store for them. How much money are they getting for us because of our need for money? Of course, they're going to lend us money if it makes sense, right? But what's in it for them? Because sometimes we're so blinded by, I need this money right now. I need this loan. I need this because I need a house or I need a car or whatever it is. And you don't even care how much the bank's going to make from you. But if we are in positions of power where we have a little bit more control into our financial journey, into our financial destiny, then we might start looking at these numbers a little bit differently and figuring out how can we put ourselves in a better position to keep more of that money than just give it over to the banks.
Right. And I think a lot of it, to your point, comes from muscle memory. From at a young age, we were programmed or we were taught to use the bank for these specific purposes. Mm-hmm. And it wasn't until when we started investing in real estate that we started to understand that there are other options. The reason why I say that is because we couldn't use the bank to finance our deals. We had to use private money. And when we started becoming a private money lender, we started taking on the position of the bank, which changed our muscle memory and change how we go about doing business. So in order for you to get some of these points that we're going to tell you about, please understand that it takes muscle memory, the action of doing it, for you to really understand it. Because right now we're programmed a certain way. And in order to reprogram ourselves in a different way, we have to take action in order to make it concrete. So it's like an example of riding a bike. You can't read a book and understand how to ride a bike. You have to get on that bike. Yeah. You can't understand how to swim just from doing your research and swimming. Mm-hmm. You have to get in the water and actually swim.
Mm-hmm. Yeah. And I think too, that's a really awesome analogy that you have, because muscle memory, if you're a runner and you don't lift weights, the minute you get in the weight room and you start lifting weights, your muscles are going to be sore in different places. Mm-hmm. And it may be a whole different ball game. It may be intimidating for you. It's going to be a completely different experience because you don't have that muscle memory of being in the weight room. And that's what we're talking about today, is we're using the bank versus using funds that come from other places. Mm-hmm. And knowing that you're still going to get just as good of a workout, but it's just going to be different.
Right.
So sit back and relax. Let's talk about this.
So now we mentioned early on is the fact that we a lot of times pay the banks more in interest than we actually save, right? Mm-hmm. So let's put on our interest hats, for example. But because so far we've been programmed to pay interest to the bank, pay interest to somebody else. What if we create a way to where we become our own source of financing
Can I interrupt?
Yeah, go ahead.
Real quick. Again, we don't want to talk over some people's heads. So when we talk about pay interest to the bank, it's about when we have a mortgage, when we have a car note, when we are charging money on our credit card, or we have a personal line of credit, like I just mentioned before. You have to pay principal and interest, meaning you're going to pay principal, and then there's going to be a little bit of interest that's tacked on. That interest is what's going directly to the bank. That's how they're profiting and making money. So with the interest that Darius is talking about, it's zeroing in on that interest, because for us, it's not just about the interest rate. It's about the volume of interest that you're going to pay over time, right? And we get that from Nelson Nash, who wrote the book Becoming Your Own Bank in the first place, which is what we're alluding to. Right. So think about the volume of interest, not necessarily the interest rate, because some people are like, I'm winning at 3%, but how long are you paying 3%? Right. I'm winning at 2. How long are you paying 2? So those are the things that we want you to focus on. The volume of interest, meaning the time or the term in which you are going to pay interest for. And then add that to the interest that you're paying on your mortgage, the interest that you're paying on your car, the interest that you're paying on your credit cards. That volume of interest, it all compounds, and that's hundreds of thousands of dollars that's leaving your pockets every year.
Right. So when you think of the fact that, let's say you earn 6 figures, or your household income is $250,000 into your home, but at the end of the year you only got $20,000. Where did that other money go? It went to pay for your debt in the form of principal and interest.
Yeah, because the average household, we're harping on this. We keep harping on this because the average household is paying more money in interest every month than they're saving.
Right. So let's get some of that interest back. How do we get that interest back? Is we become our own source of financing through the purchase of a cash value life insurance policy. Now, before you jump all over us about the life insurance policy, let's talk about the cash value that accumulates in that policy. Instead of borrowing money from the bank, we're going to skip the bank and borrow from our life insurance policy for our first option, which is our major purchases. This is where we may use a credit card or some other form of a personal loan to where we pay that interest back quickly, but we have a high interest rate that we pay. Average credit card is about 19.5% interest. Now, instead of paying 19.5% interest to the bank, we then pay that 19.5 interest back to ourselves. When we want a new refrigerator, new appliances, new windows, if we need a treadmill to exercise, whatever it is that we may finance through a credit card, what if we finance that ourselves and we pay ourselves the interest? The first thing you may say is, why am I paying myself the interest? Because if your money is good enough to pay the bank, it should be even better for you to pay it back to yourselves. Why? Because we'll then have that money to do other things with. So for our first option is our major purchases. We finance our major purchases through our own banking system so that we can then earn that money back to ourselves. And as that money accumulates, then we have a second option because we have more money to finance more things. And
it's important that if you want to start a policy, because we're skipping a step, right? You have to get a policy first in order for this to work. So if you want a policy designed for high cash value and for you to liquidate funds, especially in the very first year, then definitely click on the link below. We would love to serve you at the Wealth Nation. And also we have a membership community. So it's important for you to connect with other people who are doing these very same things. It's not just us talking about it. Come join our friends and let's have a conversation about what it is. So again, go ahead and click on the link below. We would love for you to join us in any capacity. So with the whole life insurance piece of it too, like I said, we are skipping a step. There are a ton of details that go into the nitty gritty pieces of a well-designed whole life insurance policy that has high cash value in it. So definitely click on a link here or a link down at the bottom where you can watch any one of these videos where we break this down more in detail. So right now, this video is just talking about once we have the policy, what are the action steps that we can take to then skip the bank and recoup some of that interest that we're paying.
Right.
Major purchases. I think that is a huge opportunity, a huge win for us as consumers, because think of how many times we have a large purchase, and anything over $1,000, $5,000 can be considered a large purchase. Like you said, appliances, whatever it is, it's important to use your own banking system and pay yourself the said interest that you would be paying financing it elsewhere. Right. And it really does so many wonderful things for us, because when we pay interest back into our banking system. Not only does that help us pay down our policy loans, but it also helps us grow our cash value at the same time, but depending on how much more interest we are charging ourselves. And all of the interest that is going back into our banking system is just going to allow us to continue to be able to finance more opportunities that come our way.
Right. So example of this is we're a few years into it, if you haven't started yet, but we recently purchased new windows. The conversation went, do you want to finance these windows? The answer is no, but if we decided to finance, how much would that cost? They told us the interest. Well, we want to pay cash. Oh, you want to pay cash? We're going to give you an additional discount because you are paying cash. So what we did is we paid ourselves the interest that we would have paid that window company if we were to finance it, but we then paid it with cash. So now we have more money than inside of our system to use for other things when that time becomes available.
Yeah, and that was a major purchase.
And it's easy, but it becomes easy because we're a few years into it, and we now have that muscle memory to use our own system versus using the banks.
That there's so many different major purchases that we can rattle off, and we've even shared it within our community as well. We know so many people are pet owners. How many times do you take your pet to the vet and have to pay for those medical expenses? Medical expenses for humans can be major expenses. Vacations can be major expenses. Education can be major expenses. We're literally talking about anything that you need to
potentially
finance. So a lot of times we kind of look at this financing world as like we just don't understand it, but we do it every single day. And sometimes when it's about like focusing in on what are these things that we actually finance, then we realize like, wow, we are paying a ton of interest, or we are really dependent on the banks because they got all of our stuff. Right. They have our education, they have our house, they have our cars, they have everything. So let's just take a moment and look at all of the things that we're financing, and even your monthly purchases. A lot of you are probably financing it because how many of us are charging all of our expenses on a credit card
and carrying over a balance?
That's the financing piece that we don't want you to be in. We want you to utilize your credit card, but then pay the balance off every month. So these are just different things that we're trying to plant the seeds for you so that you can start realizing, okay, maybe I could move this over, or I could move this over. And who knew? We needed windows for our entire house, and we said, we have some money in our policy. Let's see if we can make this baby work.
Right. Also comes because of the fact that we're financially aware of our spending. And when we started taking our finances seriously and having budget meetings, we started to understand where our money was flowing. So we had to focus on where that money is flowing in order for us to start redirecting those funds back to ourselves, because the way we pay our premium is through our savings. And then above and beyond that, how we pay the loans back is how we would pay any other loan back that we would finance through a credit card. And over the years, as those funds accumulated from the major purchases, we're able to purchase our car. So instead of going to a bank for a car, we're able to finance it ourselves. And when we sit down and we talk to a company that we're buying our car from, we ask how much would it cost, or how much on average does a person pay in interest? It makes the conversation go a lot smoother, a lot faster. And not only that, we're able to get the car we want instead of the car that we can just afford.
Very good perspective. And that's another thing. So vehicles, we talk about major purchases in the sense of just like maybe your household. Vehicles is a whole nother subcategory that we're talking about. And it's amazing because the banks really just give us the blueprint right. as far as how to finance a car. And Darius even asked the salesman at the dealership, if I have bad credit, what does the interest rate look like for someone who has bad credit? And he was like, oh, what did he say, 7 or 8%? And he was like, okay. And come back, he's like, we're going to charge ourselves 10. It's really kind of fun, and you can really start to design your banking system however you see fit based off of your income. Because for us, we always talk about paying yourself first. We are always going to pay ourselves first, regardless if it's savings or being our own loan sharks, because we know at the end of the day, the money is all just going to come back to us anyway, and it's going to help expand our banking systems and what we can do with it. So vehicles is something that we all have. It's something that we have all probably financed at some point. How can you look into financing a vehicle using a policy? And one thing I also want to share, because you had talked about we're a few years into this. We're not talking about like all of these things we're doing overnight or simultaneously. That this has been a process for us. We're 6-7 years into this process, and we've paid down debt. We've done, paid our rent. We've done all sorts of things with our policies. And it's because of the baby steps that we took to actually use our policies and allowing that interest to grow over time that's allowed us to buy a car cash with our policy. It's allowed us to pay for all of the windows in our house cash. So we never want to allude to the fact that like, oh, you're just going to start tomorrow and it's going to be amazing. These are building blocks. You might get a policy and have a car loan, for example, and not have all of the money available to pay off the car, which is fine. You have to start somewhere. Like Darius has said in many of our videos, we started with $120,000 of debt. We didn't have all the money in a policy to pay off that. We started with $5,000 inside of one of our policies to start chunking away at that debt. But what happened was it just took focus, it took determination, and it took discipline to start chunking away at those debts and redirecting funds back to us as opposed to continuing to be dependent in financing through the banks.
Really well said. Thank you very much for saying that. Now, the reason why this is significant is because in the first 4 or 5 years, our life insurance policy, when we paid the premium, we had less cash value than our actual premium was. So now moving forward, because we're so far into it, whenever we pay our premium, we have more available in cash than the cost of the premium. Mm-hmm. What we're able to do is we're actually able to use the funds. Because if you think about it, the whole purpose of having money is to use the money, not sit and look at the money, because sitting and looking at the money doesn't do anything for us. Right. That goes against the whole purpose of, or the whole how to use money. Money is supposed to continuously be in motion. And when you think about the money that you have sitting in your bank account, it's continuously moving in the form of investments to you, which is money coming out of your pocket in the form of debt, but becomes an investment for the bank because they're able to have their principal back plus the interest that you pay. So if we put ourselves in this position or in line to get to this point, then what happens for us is we're able to control our money instead of having someone else control it for us. Because when somebody else controls your money or controls your the income, if you're a slave to that lender, then they control your money. You work for them, you don't work for you.
And one thing that we haven't said that it's important to say is that all we're talking about is turning your liabilities into assets.
That's it.
We're just flipping the transaction because right now all of our liabilities are assets to the banks. All of our loan paperwork is an asset to the bank. Why? Because we're sending them money every single month. That's an asset to them, but it's a liability to us because it's taking money out of our pocket. Mm-hmm. So now we have to flip the script and go, okay, how can we turn these liabilities into assets for us? How can we start cash flowing on these things? And that's why for us, all it was looking at a different mechanism in which we could store money that will allow us to redirect the funds. Remember, going back to my runner analogy, we went from runners to weightlifters. We're still getting a really great workout, but we're just doing something different that maybe gives us a little bit more tone or shape or whatever you want to call it. So in this instance, we're redirecting where our funds are going by turning our liabilities into assets. Now our car, which is a depreciating asset, is cash flowing for us because we own the debt. We own it. We're making monthly payments back to ourselves every single month for the loan that we took out for ourselves. Same thing for any other thing that we finance. We're just redirecting where those funds were going and sending it back to us.
Right. Now, again, if we continue on this route because we're able to finance bigger and bigger purchases, what about our investments? What if we use our own banking system to then invest? Not only are we able to earn the money that from the investment, but that investment is now paying back the interest in which we would have that it cost us to borrow the money, and it's also able to take care of our premium depending on how well we're doing with this investment. Now our money's making money for us and providing us additional death benefit.
So we're talking about major purchases in your house, and we're talking about cars because we figure cars are going to be a little bit more expensive than some of the major expenses in your house. Then the next stair step is investments, which is all about cash flow. Everything that we're talking about here is about cash flow. How can we redirect and get some money coming your way? So when we think about investments, what are you into? What's your thing? And whatever you figure out what your thing is, then you're going to move the cash from your policy into that vehicle that should be cash flowing for you so that you can earn even more larger rate of returns.
Right. So in these examples, we're saying to skip the bank and take on that position. Now, you don't have to worry about going and getting all these certifications to take the position of the bank because you're not doing it for everybody else. You're doing it for yourself personally. You don't need any type of thing other than your cash value life insurance policy to take on these responsibilities for yourself and for your family. And when you're able to do these things for your family, you're able to direct all the interest that would have otherwise gone out of your household back to your household.
I think that's important to understand that.
Right. Because, also as you do research on the banks make so much money till they lend out a percentage of those funds back to you in the form of interest. But they only lend about 15 to 20% of their income back to us. What are they doing with the other 85, 70%? They're using it to invest.
Money.
They're using it to make more money. So we should be doing the exact same thing. There's nothing that the banks are doing that we can't do for ourselves on our own scale.
And not to just talk about the banks too. We're talking about life insurance as a storage vehicle. So the life insurance companies, they got to move money too, and they have to come up with I say safe, but strategic assets where they're going to be cash flowing, because they have to pay money out to all of their consumers who pass, who are doing loans, who whatever their money transaction is. They have to always have cash on hand. So like the banks, they're not going to not move money. Neither are the insurance companies. So that's why we have to take a note from everyone's book and say, what is the commonalities? They're moving money. So we got to do it too.
Yeah. When you think about it, the banks are just charging you for access to a pool of funds, right? The banks are also purchasers of life insurance policies in order to do the exact same thing that we're telling you to do. So the interest that you're paying to the bank, they're then using those funds to buy life insurance policies and then loan you the cash value back. Why not skip the bank and start doing it yourselves? The only thing we're saying to do is create a pool of funds that you then, whenever you access, you pay yourself a fee for access to it in the form of interest.
Now, pool of funds can sound intimidating, and we're talking about moving money and all sorts of stuff. Like we really want you all to understand that you can literally move money with $500. We're not talking that you have to have thousands or tens of thousands or hundreds of thousands. Like we said, when we got started, we were moving $200 at a time, and now it's 10x that. So it's really important for you to just respect where you are. Respect where you are right now and figure out what can you do with what you have right now. Stop trying to emulate what everyone else is doing or spend the money that everyone else is doing, because you may not have those funds. We just want you to look at what you have right now and start being better patrons to the money that you have right now. So we say put some respect on it. So again, don't look at what it is that we're saying and think that, oh, I can't do this right now because I don't have enough money. You always have enough money. If you got $2 to rub together, you can figure out a way to make 2 turn into 4 and compound that sucker. So again, just want to put some perspective to this, because I understand when people are talking about money, we've been there where we just felt like maybe there were times where we just couldn't get involved, couldn't get in the game. And we recognize that every single month that we waited, every single 6 months that we didn't do anything, we were still stuck in the mud and not progressing. Right.
And I know we're hitting you with a lot of different concepts and different scenarios. So if you want to better understand that, check out the link here. We're going to link our masterclass so that you can get a better understanding of how we are suggesting that you use the cash value inside of life insurance.
Absolutely.
Now, the fourth point we want to make is the fact that Carmen mentioned earlier is the volume of interest is the thing that we're after. Mm-hmm. And when you think of volume of interest, your mortgage, mm-hmm. you might have a smoking deal on your mortgage at a 3% interest rate, but over 30 years, you're paying a lot more than what you actually think. Mm-hmm. So if we can use our system, our banking system, to own our mortgage, think about how much interest we can have over that 30-year period that we don't necessarily have to pay back to the bank, but we're able to control for ourselves and then use those funds to make additional funds with, make additional money with.
Totally. It's really just learning what checker pieces you want to knock off first. And sometimes we tend to prioritize things that maybe not will give us the biggest bang for our buck, as opposed to understanding the whole board and what we're playing with, if that makes sense. And that there's always so much marketing and things out there where people are saying what you should do and this and that. And that's why we always talk about look at the numbers, what makes sense for you, because what the marketing might say may not make sense for your specific circumstance. So that's why if you've done everything that we've already talked about, between the expenses for your homes, your cars, your investing, and you're at the point where you have a mortgage, maybe it might make sense for you to look into your mortgage and how can you start financing that or taking more of that ownership so that you can start financing it. But if you're just getting started, it doesn't necessarily make sense for you to start knocking off your mortgage because you may have other assets right in front of you that you can knock off before and get just as much return.
Right. And the reason why we save mortgages for last is because for most of us, that's our largest expense that we do have. We're not able to get $500,000 from our insurance policy and we only had it for 2 years to pay off our mortgage. But what we can do is we can build up to that before our 30-year mortgage is over.
And also, too, it's just you're tying up a lot of cash.
That you can use to make more money.
Yeah. And so that's why we're always, we don't necessarily preach paying off your mortgage as fast as you possibly can, because we think that all of that money that you would go to pay off your mortgage, you could make 10 times that amount of money than what you would do just throwing it at your mortgage. So again, it's all about just looking at the numbers. And if you are so hell-bent on paying off your $500,000 mortgage, I just want to know what else could you do with $500,000 than just paying off a bill.
Right.
Think about that, because sometimes we are not okay with just making the payments. And in this case, I would just be okay with making the monthly payments to my mortgage because I know that I have so much more money to work with, and I can send them $2,000, every single month so that I can continue to work with whatever the delta is that I owe, and continue to flip that. And then maybe what I would do is take the money that I have earned from an investment and pay off the house, for example, instead of taking my income and sending it to the mortgage.
Right. At the end of the day, our financial system is made up of banks, insurance companies, and our stock market. What are they doing that we can't? The only difference is they have more money than we do, but on a smaller scale, we can do exactly the same things that they're doing, which we are, but we need to be more intentional about. Banks purchase life insurance policies. Insurance companies also invest. What are we doing to have our money make more money? They're in the money business. So should we?
I love it. So in that instance, if you want to get in the money business, then definitely check out our next video where you can learn the steps in which you can start taking action.
Remember to own your own lifestyle,
or someone else will.